Good morning or afternoon, everybody. Nice for you to join us today. As Andy mentioned, my expertise and background is in compensation, and we started RCReports back in 2010. I suspect quite a few of you already know who we are. If you're not familiar with us, we built a software platform that determines reasonable compensation for closely held business owners. However, we didn't build it for their use directly. We built it for you folks, for evaluators, CPAs, EAs to use when you need to determine a reasonable compensation figure for a client. We built it around IRS criteria, guidelines, and court rulings, and it will deliver an independent, unbiased, reasonable compensation figure, which makes it defensible with the IRS, defendable in court. If you are multitasking, you want to learn a little bit more about some of that, and I suspect we'll talk about more of that toward the end or in Q&A as well. We have quite a bit of information on our website about our track history there. Just a quick background on where RCReports came from. I've spent my entire career in and around human resources, executive search, and compensation. And in the 2000s, I began doing reasonable compensation engagements, one-off studies. And they were all targeted at compliance issues, mainly with S-Corps that had a spike in reasonable comp challenges at that time. Long story short, I got together with 2 or 3 other experts in their fields, and we started to develop a faster, more efficient way to determine reasonable compensation. Back then, it would take us 4 or 5 hours to do an engagement at the quickest, sometimes a few days. And then those studies would easily be somewhere in the $2,000 to $4,000 range. And our biggest frustration internally was just getting the data. So we built the program, put it out there, launched it in 2012. Took us about 2 years to build it out. And our only feature then was for compliance. But it was in early 2013, we had our first valuator reach out to us and ask if they could use it for valuation. We said absolutely. However, the platform really wasn't designed for normalizing, so to speak, mostly for compliance. And that gentleman was Stephen Kirkland, who maybe quite a few of you already know. He became, I don't know, like our 20th user or something like that. 2015, after many more evaluators reached out to us, we went to a NACFA conference and started gathering more information. Long story short, in 2018, we released a major upgrade and update to our system, including new data sets and functionality to address what evaluators were looking for in the product. And I suspect we have quite a few of those beta testers with us today, which I very much appreciate that and the feedback. And so what we're going to take a look at today, we built based on a couple of years of research and a lot of feedback from folks in the valuation community. So thank you very much for that. So it's still morning in my area of the country. So if you guys want to grab a cup of coffee or if it's after lunch, whatever, and we'll get started. I want to briefly put up our agenda since this does qualify for CE. I don't know what you all know, so I'm going to spend just a couple of minutes going through what reasonable compensation is and why we care about it. We're going to spend some time going through the 3 approaches that are commonly accepted: cost, market, and income. Then we're going to break off and we're going to do a case study and take a look at how RCReports would be used in a normalization for a closely held business. And then we'll break off into some other areas that a lot of you may be interested in as well. We'll talk a little bit more about making professional judgments and other adjustments to a reasonable compensation figure. If you're doing expert witnessing or litigation, how reports should be used, handled, backup information, etc. And both along the way and at the end, we'll set some time aside for questions. So let's go ahead and get rolling. Since I don't know what you know, we're going to start in the shallow end of the pool, so to speak. So reasonable compensation is defined in a few different ways. First is as a question: how much compensation would be paid for the same position held by a non-owner in an arm's length employment relationship at a similar company? The IRS's definition right from the code states that reasonable compensation is the value that would ordinarily be paid for like services by like enterprises under like circumstances. And this is the definition we typically see valuators use: the hypothetical replacement cost of an owner or key manager of a business. At RCReports, we've kind of boiled those down into two a little bit shorter definitions. The first one is replacement cost. As a business owner, if I had to go out into my community and hire somebody to come in and perform all the same services I'm performing, what would that cost me? Replacement cost. And then the flip side of that coin is fair market value. As a business owner, if I shut down my company and I went across town and worked for the competitor, what would the competitor pay me for those same services I'm currently providing to my company? A little easier for us to think about it that way, much easier when we're explaining it to our clients. The absolute best explanation of reasonable compensation I've heard when talking to a client goes something like this: slide a checkbook across the desk to them and ask them what number they're willing to put on there to hire somebody to come in and do what they do. A good example of that was working with a CPA who was consulting with a C Corp, and it had a single owner, and she had a very successful business doing about $50 million a year, and she was paying herself $7 million a year in salary. And he just couldn't get through to her, so finally he said, if you need to step out of your company, what are you willing to write the check for? Would it be $7 million? And pardon my French, but the answer wasn't just no, it was hell no. Actually, it was more than that, but we'll go ahead and tone it down. That's not a bad way to get through to some owners if they're just not seeing or understanding the concept. So why do we care about reasonable compensation? Well, from a strictly numbers game, it's compliance. S Corps and C Corps are typically where you're going to see compliance issues, sometimes with family members within closely held businesses as well. I don't know about you all, but it was nice as the lockdown started to let up to go out and get a haircut, because I chose the Muppets because before those haircuts, I was looking a lot like a Muppet. Other reasons we might care about reasonable compensation? Well, for you folks out there, for normalization, valuation, shareholder disputes, divorce, reasonable compensation almost always comes up, and it tends to also be a factor in litigation. Whether the valuations are headed that way or not, you guys typically build them for litigation. And my favorite is planning, right? If you're doing any planning with your clients, any consulting, exit planning, entity planning, retirement planning, et cetera, knowing what that reasonable compensation figure is key. So now that we know what it is, why we care about it, let's go ahead and dive into why we're really here today. How do we determine reasonable compensation? So in the last 10 to 15 years, there has been a tremendous amount of information that's come out on reasonable compensation, including approaches and methodologies, court cases, et cetera. But prior to that, there really wasn't a lot of information out there. Now, a lot of reasonable compensation figures were kind of determined by taking some basic facts at the beginning, kind of looking at them, making a judgment call, divine intervention in the middle, whatever you want to call it, and then coming up with a recommendation on the other side that didn't really have any backup or any basis or fact to support it other than gut feel, judgment, et cetera. That all began to change in the 2000s, and especially in the 2010 to 2020 timeframe. A whole lot more information has come out on reasonable compensation and approaches and data sets to use, et cetera. I will say this about the different approaches that are out there. There's still a lot of judgment that goes into reasonable compensation, a lot of subjectivity. So no one approach is perfect, but usually one approach fits a client much better than others. The different approaches we're going to look at today are also documented in a job aid put out by the IRS. This was an internal job aid put out early 2000s. Those of you that know Michael Gregory, I suspect quite a few of you at least know the name if you don't know the man. Terrific individual. He worked for the service for close to 30 years. He was instrumental in having this job aid put together. But what we really have him to thank for is he filed the Freedom of Information Act to have it released to the public. So there's a link to it in your handout if you don't already have it. It's a great resource to have around. In addition, if you are dealing with the IRS on it, it goes into detail on not only the 3 approaches we're going to look at, but how examiners will develop issues and pursue them with the IRS. So good resource. Another good resource, if you don't have it, Michael put together a very, very thorough reference book on valuation in the IRS. You can go to Michael Gregory's website. I'm pretty sure there's a link to it in your handout as well. If not, it's easy to find in a quick Google search. And he does have a whole section in here devoted on reasonable compensation as well. So let's go ahead and dive into 3 different approaches for determining reasonable compensation. The first one we're going to take a look at is cost. And I will mention this, the approaches for reasonable compensation, they don't mirror the approaches for valuation. So try not to keep those things mixed up or confused. And I think it's also why the IRS Job Aid, when they talk about reasonable compensation, they explain it using a different comparison. They explain it using how a real estate appraiser appraises property. And they did a really good job, and I like using that same comparison because it really does help advisors remember the different approaches and separate them in their mind. So when we're talking about the cost approach for determining reasonable compensation, it's very similar in how a real estate appraiser is going to come up with a cost to build a new home. We're going to start off with a set of blueprints. We're going to do a takeoff of all the material and labor needed. We're going to add all that up, and we're going to come up with a cost to build that home. Also known as the many hats approach. The cost approach for determining reasonable compensation is very similar. It takes into account all the different tasks a business owner performs, all the different hats, such as administration, accounting, marketing, etc. And then it breaks the time spent by the owner down into the various tasks that are performed. Wage levels or skill levels are assigned, and then they're added back together to obtain a hypothetical replacement cost for the owner using comparability data. So we're going to talk a lot about comparability data today. In the cost approach, we use a data set called the cross industry because it is the most thorough. And we're talking about all the different hats a business owner could wear, including one specific for their own business. The cross industry database has the information and the quantities that we need to be able to pull that data up. We tend to see this data used most commonly at a very local level, such as city or county. If we can find hourly wage data, that's helpful because we're typically breaking the duties of the owner down and then building them back up. And we tend to see the cost approach used mostly for what we're going to call small businesses or micro businesses. And these are businesses where the owner is still wearing multiple hats for the business. You can sorry, I just caught a question. I'll come back to that here in a second. So when a business is either young or maybe it doesn't outgrow a certain size, you'll tend to see business owners still wearing multiple hats. So for instance, maybe you have a plumber who has a small plumbing company with a couple other plumbers working for it. So he's going to be maybe doing some estimates, also working in the field, maybe some accounting, just the different hats that they may wear. Word of caution on the cost approach, and this is mentioned in the IRS Job Aid, is when you're talking about multiple hats, you don't want to stack them one on top of the other. So if you have 3 different hats that you're wearing, and let's say they all cost, or they're all valued or comparable data at about $100,000 each, we don't want to take those $100,000 and stack them on top and say reasonable compensation for this individual is going to be $300,000. What we want to do is blend them together and would still come up with a reasonable compensation figure of $100,000. So the next approach we're going to take a look at, and by far, this is what valuators' approach would be their favorite, called the market approach. And if we are back to being a real estate appraiser, this is how we're going to determine reasonable this is how we're going to determine the value of a home within a tract neighborhood. So the neighborhoods are going to be different, but the homes in them are going to be very, very similar. So as a real estate appraiser, we're going to go in, we're going to find homes that sold recently, and then we're going to compare them to the house we're trying to value. We'll make some adjustments up and down, and we'll come up with a value for our subject property. Also known as the industry comparison approach, the market approach for determining reasonable compensation is very similar. It determines the owner's compensation by looking at the compensation of employees in businesses of similar size and from the same industry. That's the same neighborhood. The market approach focuses strongly on the owner's business and the specific position held by the owner. And that's typically going to be a management position. There's a really practical reason as to why. I'll get to that in a minute. This approach then compares both the business and the position of the owner to that of its peers to draw a conclusion for what reasonable compensation should be. And the market approach tends to work well for what we're going to call medium businesses. And medium businesses are businesses that have grown up to the point where the owner is now either exclusively or predominantly in a management position. And if that's the case, we'll probably want to take a look at the market approach. And the real practical reason for this is industry-specific wage data is like hen's teeth. It's very, very hard to come by in the kind of quantities you need to make it reliable. However, there is a couple of occupations, management and executive level positions, where it is gathered in large amounts. So it's kind of a practical reason why we tend to use just management and executive positions for industry specific, but it also tends to fit mostly for what we're using it in the valuation world. Last is the income approach. This approach is probably the least used of the three different approaches, but it is a good one for you to know about. If we're back to being a real estate appraiser, this is how we're going to value commercial real estate. We might be interested in what it costs to build the building. We also might be interested in what a building down the street sold for as a comparable. But what are we really interested in if we're a commercial investor? We are interested in how much money are we going to make? What's our return on investment if we buy this building? Also known as the independent investors test. The income approach for determining reasonable compensation is very, very similar. The biggest difference between the income approach, however, and the other two approaches we just talked about, the cost and the market, is that we're not using comparability data. We're relying on a very simple formula put out by the IRS. And it seeks to determine whether a hypothetical investor would be satisfied with their return on investment when looking at the financial performance of the business in conjunction with the compensation level of the owner. So when would you use the income approach? Well, one would be for outliers. So if we have an outlier, this is typically somebody that we can't find comparability data for. If we can't find comparability data for them, then we can't use the cost or the market approach. This is also a great approach for either a second opinion to either the cost or the market. It can also be a good way of testing out not only your own reasonable compensation conclusions, but if you're headed to litigation, you may want to be using it to test the conclusions of the other side. So how do we classify outliers? Who might be an outlier? Well, there's somebody who has either a unique occupation, also people who we tend to refer to as key employees or superior employees who are getting results so much far and above their peers that they deserve extraordinary compensation, and so comparability data may not be useful in that area because the wages at that level just simply exceed anything that might be being collected up to this different percentiles. So just a little bit of trivia for those of you out there. I'm a product of the 60s and 70s, and I owned a pet rock, and I don't know if any of you all owned pet rocks, but that is Gary Dahl, the inventor of the pet rock. He had a warehouse and shipping business, a wholesaling business, and I suspect he might have been a good candidate for the income approach, because his results and the money he made putting rocks in boxes and selling them was far above other wholesalers and direct mail direct shipping companies at the time. So armed with the knowledge of the three different approaches, let's go ahead and move into a case study. So this case study I built based on a contractor that I know here in Denver. None of the information in this is directly from his business, but it is kind of based on a 10,000-foot view. Johnston Signatures Homes is owned by Mike Johnston, and he has both his daughter, Kim, and his son, Brian, working in the company. Mike started out with a degree in architecture, worked in the industry, worked in construction, and in his 30s, launched a custom home company. And he's now in his 60s, been running the company for 20 plus years, maybe even close to 30 years. And in the Denver area, we have these older areas where home builders will come in, they will buy original homes that were built in the 20s, 30s, and 40s, and they'll pay anywhere from about $500,000 up to north of $1 million for these original homes. And they're buying them for the privilege of tearing them down. So we call these lots scrape lots. The builder will come in, they'll spend that kind of money for the lot, they'll scrape the house off, and they'll put a brand new one on there. And that's a lot of what Johnston Signature Homes does. And the homes that they sell, the custom homes they sell, typically sell somewhere in the $1.5 to $2.5 million range. So Johnston Signature Homes is doing about $50 million a year in gross revenue. They have 35 employees. Most of the folks that they employ are subcontractors. And we need to normalize the compensation for Mike, Kim, and Brian. So let's go ahead and start off with Mike. First thing we need to do is gather some needed information. Do an interview with Mike. What do we need to know? What does he actually do for the company? So in interviewing Mike, he is responsible for the overall management and direction of the company. His son, Brian, along with a couple other managers, take his overall vision and direction and implement it. He's key in certain supplier and vendor negotiations, also key in certain relationship management positions with realtors and bankers. If need be, they'll bring Mike in to close a client if warranted, and he still puts in quite a bit of time for his company. He's working 50 plus hours a week. In addition to that, Mike also personally guarantees debt and surety bonds and speaks fluent Spanish. Kim, his daughter, has the title of vice president, and she has quite a bit to prove to both her father and her brother. So she spends quite a bit of time in the company, 60 plus hours, and she wears quite a few different hats for the company. She does some of the bookkeeping and some of the payroll. She has some help with that. She is the only person there responsible for benefit administration and some of the insurance administration, such as work comp. She spends the majority of her time, however, in sales and managing the other sales folks in the design center. And Brian. So Brian implements his father's strategy and direction. He is also key for training new employees and overseeing those employees and subcontractors. He also fills in for key employees in the field, such as the project managers or superintendents for the project, is key in training those folks as well. And he puts in a 45 to 50 hour work week. So once we've gathered this information, now we're going to go ahead and normalize compensation for these three folks. And we're going to start with Mike. So I just brought up my RCReports dashboard. When you log in, you're going to log into what we call the dashboard, and you're going to come up with the announcements page. Everything that happens within RCReports, or the overall majority of it's going to happen in what we call the Clients tab. So to do a reasonable compensation report or study for any of your clients, the first thing you're going to do, click on New Client and add their information in here. We require first name, last name, a business name, and an industry code. Some optional information we have in here is email and phone numbers. Those are for your convenience, and there's some features in the software if you put an email address in that you can take advantage of. But all this information, because privacy is quite important, not only to you, but to everybody nowadays. We don't contact, reach out to, or have any interaction with your client. The information in here is strictly so that you can complete a report tailored specifically to your client. So I already have in my client dashboard here, Mike, Brian, and Kim set up. I'm going to go ahead and pull up Mike's profile. You're going to see I've already done a couple of reports for him, and they're listed right here. And you can see I already have his details in here, including his makes code. So we want to run a report for Mike. Simple enough, we just click on Initiate Report. We have 4 different reports available right now. What we're interested in today is normalizing compensation for valuation. So selecting the purpose for your report will not change the resulting compensation figure. The reports simply read to certain or different reasons or purposes, tax compliance, normalization, and planning. So we're going to be running normalization reports today, so we'll go ahead and select that. Now the next option or choice that we want to make will affect the reasonable compensation figure at the end, and which approach do we want to use? Well, what did we learn about Mike? Well, Mike is running the company at a management or executive level. And so that's going to tell us that the approach that's likely going to fit for Mike and what he does for his company is going to be the market approach. So we're going to go ahead and select market approach. And now we have, I don't know, probably 8 to 10 inputs in here. Once we have those inputs in here, we'll get a reasonable compensation figure for Mike. What year do we want to run this report for? Well, we're going to do reports for 2019. We've already got the industry code in here. And if you look at the industry code up on the screen right now, you're going to see that we have industry code 236000. And that is because our wage database is accurate to 3 digits. Now the NAICS code does go out to 4, 5, and 6 digits, but there's simply just not enough collection of data out there to support a confidence level that you'd want to use in any kind of a reasonable compensation challenge, litigation, et cetera. So we go out to 3 digits in the NAICS industry code. Anytime you see learn more, you can hover over that. We have 2 different levels of management. We have a GM or operational management level, and then we have an executive level. Biggest difference between the two, general and operations managers tend to be frontline or first line managers overseeing employees. Executives tend to have different other layers of management beneath them and are responsible for the overall direction of the company. So in this scenario, I believe that chief executive is going to fit best for Mike, so we're going to select that. We are in Colorado for this example. And if there are metro areas nearby, we'll go ahead and include those. And so Mike's business is here in the Denver area. Once we've selected all of our basic criteria, we're going to click on the second tab and we're going to put in the business information for the company. What do we know about Mike's company? Well, it has 35 employees. The adjusted gross profit for Mike's company is going to be between probably between $10 and $15 million. So the next 2 inputs that we need to decide on are going to be judgment calls, right? There's a lot of subjectivity that goes into this. So how do we want to rate Mike's business compared to other custom home builders in the area? Well, I'm going to start out with average, and I always recommend start at average and then move her up or down if you have a reason to do so. Along with rating the business, we also have to rate Mike himself. And so for Mike, we're going to put him above average. He has a degree in architecture. He's been doing this for 30 some years. He seems like and rates himself above average. And all of these inputs are editable. And then last, we have time dedicated to the business. And Mike is working in that 50-hour range. So we're going to go ahead and select overtime. And once we've done that, we are going to get reasonable compensation figures for Mike down below at the local, state, and national areas. And we're going to come up with ranges from low to high and suggested. And if we come in here and make any changes, the numbers down below will automatically update. So this is probably a little bit better gauge of Mike and his business. So once we have these inputs in here, we can go ahead and convert it to a report. And we can pull that report up and take a look at it. So these reports, or at least reports that are very, very similar to this, are in one of your handouts today. I'm not going to spend a lot of time scrolling through them. You can take a look at them on your own, but they do read to the specific reason the report was run, for this case, normalizing compensation, with an overview page. We'll probably swing back to this a little later, this particular page, or at least some of the questions you have in here, as far as methodology and how that reasonable compensation figure was calculated. Let me jump back to our PowerPoint here for just a second, and Mike. And one of the common questions is, what's included in that number? Basically, what's included in that number is taxable Medicare wages and bonuses, healthcare, and savings accounts. What's not included there are things that are typically not reported on a W-2 as taxable compensation: vehicle allowance, stock options, company loans, etc. So this definition of what is and is not included is also part of the report. And as I mentioned earlier, we use the market approach for this. And so each report has a summary page with the different parameters we use to determine that reasonable compensation figure. So for Mike, we finished up with Mike. We've got a reasonable compensation figure somewhere in the high 200,000 range, even to the low $300,000 range. There's a few questions coming in. I'll be happy to stop and answer those, but I'd like to go ahead and get all the way through the case study first. If that's not the case, Andy or Jared, just pop in and let me know, and I can take a break and answer questions. Next, let's take up Kim. Now, Kim wears quite a few different hats for Johnston Signature Homes. So in this scenario, what we're going to start thinking about is, what approach do we want to use for Kim? Well, let's come back to our RCReports dashboard. I'm going to go back to the Clients tab and my clients list, and I already have Kim in here, Kim Johnston Myers, and we want to initiate a report for Kim just like we did for Mike. But this time we want to think about what approach fits best for Kim. And knowing that she's performing multiple tasks for Johnston, the cost approach is likely going to be the one that's going to fit best for Kim. Now, you can use any of the approaches for anybody. It's just that certain ones are going to fit so much better. You can even use multiple approaches for the same individual and then reconcile them against one another. So for Kim, we're going to use the cost approach. We're also going to do it for 2019. Because the cost approach gathers quite a bit more information, there's a little bit lengthier interview and information that we need to gather. We built an online interview platform for the cost approach that you can email out to your client. It's optional whether you want to do that or not, but if you do that, this is one of the options down here. When they finish that online interview, do you want them to see the results or not? So we're going to do this one on our dashboard, so we do want to see the results at the end. But if we were sending this off to Kim or one of our other clients, we may not want them to see that, so we'd select no. And do we want to be notified when they finish the interview? We don't, because we're going to be doing it here on our own dashboard. Click Initiate Report, and there's a number of options up in front of you. You can send that email invitation I just mentioned. You can also add working title and notes, and this was a suggestion from the valuation community. So apparently you guys like to run multiple scenarios, so you can tag the reports with whatever additional metadata you'd like to keep them straight and organized. The very last option is a paper version of the interview if you want to send it out to your client, but what we care about today is the actual interview. So let's go ahead and click here, bring up that interview online. There's 7 steps plus a wrap-up step. If your clients are doing this on their own, it's going to likely take them in the 15, maybe 20 minutes to run through it. We gathered the information ahead of time. We can put this information in generally in less than 5 minutes. So we're just going to walk through these steps at the top. First thing we're going to do is zero in on our location. We are in Denver, Colorado. We're going to select hours. Now, Kim works quite a bit of hours for the company. We typically do not recommend you go over 40 hours because that is the industry standard. And in the compliance world, we've seen hours held at 40 hours, even for those that work much, much more. However, for normalization, planning, other areas, we do allow it to go over 40 hours, and we're going to do that for Kim because she does put in a tremendous amount of time. And we do have a warning in here if you go over 40 hours. So we'll set her hours to 60. When we developed the software, we did quite a bit of research and polls and learned what different hats most small business owners wear. And in doing that, we came up with 8 categories here on the left, from maintenance all the way down through management, that small business owners may perform tasks in. And all the business owner needs to do, or if you're doing this with the information in front of you, is just simply go through all the different categories and select any of the tasks that the business owner, or in this case, the business owner's daughter, is doing. So what we know about Kim from the research is she spends some time doing sales, mainly in the design office. Under bookkeeping, financing, she does some bookkeeping and some payroll. So we'll add both of those to her profile. Under human resources, she's the point person for healthcare, workers' comp, that type of thing. And I always recommend look at the descriptions, not so much the title. Human resource clerk. And you can select as many or as few of these as you'd like. Information technology doesn't do anything, but down here in management, she also manages the different sales folks in here. So we're going to select sales manager. And once we finish with all the standard tasks, then we can move on to what the business owner does directly for their company. In Kim's scenario, oops, I jumped over a step. Let's jump back here. In Kim's scenario, we don't have anything selected in here. But think about for a plumber. In here, that's where we would add plumber or architect or hairstylist or whatever might be specific to the business owner. But for Kim, we were able to find all the different tasks that she currently performs under standard tasks. So nothing in here, but we do have over 6,500 different titles in here that you can keyword search or use the alpha tabs to locate what you're looking for. So kind of following those guidelines set out in the IRS Job Aid, once we know all the tasks that our business owner is performing, then we just need to apportion out that time. So in the questionnaire that we provided Kim, that we gathered, she told us that she spends roughly 28% of her time as a salesperson directly. 33% of her time is going to be spent taking care of bookkeeping and payroll. 10% of her time, human resources, and the remainder of her time managing the sales staff. And sometimes this is enlightening for business owners as well to see where they're spending their time and what value is attached to it. We're almost done. Once we've apportioned out all of our time, now we have to simply rate Skill level experience, we call it proficiency. We call it proficiency for a reason. You can have 30 years of really bad experience, 30 years and still not be good at something. So proficiency or skill level are a much better or more accurate way to look at this. So for Kim, we're going to move this to above average. For sales, so under finance, we have bookkeeper and payroll and time clerks. Since we have two under this particular category, we do have to apportion our time in there. And we're going to leave both of these at average and just split them up 50-50. We're close to it. Human resources, not an area she excels in or very has much interest in, so she's rated herself below average. And then last is a sales manager, above average. She's very, very good at not only sales, but managing her department. At this point in time, we've finished up. We'll do a quick overview to make sure there aren't any missing pieces of information. As long as everything that's there, there isn't any other missing information, we can take a look at the report for Kim. And the cost approach reports are going to look a little bit different from the market approach reports. And the biggest difference between the two is the market approach comes with ranges because we can come up with an algorithm, a scientific way of coming up with what that range would be based on all the data we have. When we start blending occupations across multiple industries, et cetera, we can come up with a range, but it's going to be a judgment call. It would be something picked out of thin air, like 10%. So we have not instituted a range in here because, again, it would just simply be kind of pulled out of thin air. But it does include exactly how the reasonable compensation figure was reached. And this is probably the most valuable page when it comes to litigation or IRS challenges on reasonable compensation because it shows you exactly how that reasonable compensation figure came about. As you can see, her least valuable tasks here are going to be more of the administrative ones, bookkeeping, payroll, and human resources. So maybe she's better off hiring somebody for those and moving into sales, more into sales and sales management. So again, with Kim, the cost approach uses the same parameters as far as what's included and what's not included. And the methodology and the other details on how these figures were reached are included in the details of the report. As I mentioned earlier, the full reports, including all the breakdown details page that I suspect a lot of you are interested in as part of your handouts today. So next we're going to take up Brian, but I am not going to spend time going through RC reports and going through Brian's profiles because Brian, because of his position in the company, kind of falls in a gray area for us. In that gray area, because he does quite a bit of management as well as occasionally filling in for people, he kind of fits into both approaches, right? We could use a cost approach and kind of break out those different hats, but we could also look at the market approach and an operations manager, where he is, which does include quite a bit of different activities and helping out in other areas. So for Brian, which way do we go? Well, you don't always have to decide. You could run both and see kind of how they came out. And in this case, the market approach came out a little bit less than the cost approach, but still came in within the same high range. So those of you that want to run multiple approaches, you can simply do that, and then you can maybe reconcile them together. If this were my project, I would probably run both of these. I would probably, since they both fit Brian pretty well, I'd probably split it down the middle and suggest a reasonable compensation figure around $165,000. Remember when we met Mike a little bit ago and we looked at all the things that he does for his company, including a couple of factors that we haven't taken into account yet. right? He personally guarantees some debt, speaks fluent Spanish. Well, this is this part of RCReports that we spent quite a bit of time on when we built it for evaluators, and that is allowing a functionality as part of the platform to include your own professional judgment. So let's go ahead and do that with Mike. So we've accounted for the other things that Mike has done, but we haven't been able to account for some of these other things. So when we go back to Mike's profile, we have a drop down here with a number of different functions in here. I'm not sure if I saw the question or not, but it always comes up, why do the reports say draft on them? Reports are editable for up to 30 days. If you want to lock those reports ahead of time and take that draft stamp off, you can no longer edit them, but the draft stamp is removed, and that's that option that's fourth from the top. But what we want to function on or zero in on right here is the advisor worksheet. We're going to want to pull that up for Mike. So warning here, if you're going to make an adjustment to the reasonable compensation figure, make sure you know why you're making that, and we suggest that you detail the reasons for making those adjustments. And we have some of the more common reasons you may want to adjust the compensation level listed here. And for a market approach report, you can select your starting point. So we're going to start at the suggested of 272. And because he is personally guaranteeing debt, we're going to make a judgment call of increasing his compensation by $30,000. And unique requirements or skills, multi-languaged, very helpful in his particular line of work. And we're going to make a judgment call and increase his compensation again by $10,000 there. And we're going to come up with an adjusted figure of $312,000. And you can also add as much additional background and notes as you'd like in here. Now, this will not change the reasonable compensation figure on the report. That's based on comparability data, and we don't want that number being changed internally. As you can probably understand, that would probably cause a lot of confusion and problems if people could go in and change that number. But you can print this out and attach it as an addendum to the report, supporting why you made a adjustment to the reasonable compensation figure based on comparability data that was put out. So the other thing we could do in here if we wanted to is we could start with a different starting point, not put any adjustments in here, and just put those same notes in at the bottom. And print that same worksheet. And it's 6 of one, half dozen of another, but the point is you can go in and you can change those reasonable compensation conclusions using your professional judgment. So the only approach we really haven't talked about today is the income approach. And again, for the valuation community, what I like the income approach for is for double checking your conclusions based on the cost of the market approach, or if you're going into litigation, testing the other side's conclusions. So let's go ahead and just quickly run a income approach on Mike. And if you've ever heard the term, simple isn't always easy, we're pretty much talking about the income approach. You only need 3 pieces of information. Again, we're doing normalization report. This time we're doing an income approach for 2019. The 3 pieces of information you need aren't always easy to come by. So you need a fair market value of the business at the beginning of the year. You need it again at the end of the year, and what you need is that difference between the two. So for Mike, we're going to go ahead and put in 1.7 million. The increase over the year is going to be 500,000. Again, before we've paid Mike or considered his compensation. Now, what is an independent investor going to be looking for as a return on investment? Again, not an easy question to answer. We're going to use a target of 15%. Those three pieces of information, you're going to get a reasonable compensation figure and range. And it's going to suggest in this scenario, $255,000. So paying Mike $300,000 may not fit this scenario very well. Or I'm sorry, his reasonable comp in this scenario would be $245,000. And again, we can convert that to a report and save it. What's interesting about the income approach is that you can come up with a negative amount. It's very possible. It's just a simple formula. It is an approach that's out there. It's recognized. It does have its place. And so it's good to know that it exists. But for the majority of footnoting your reasonable compensation adjustments or normalization adjustments as part of your evaluation, most of you are probably going to use either the market or the cost approach. Before I move on to some of the other parts of our webinar, I'm just going to spend a few minutes going through a couple of the questions and seeing if they apply currently to what we just kind of went through. Somebody asked if a client is in more than one NAICS area or industry. I would recommend run 2 reports, one for the 2 different industries, and then reconcile them together. Somebody asked sources of data. That's where we are right now. So let's answer that one. Size of companies. Let me pop back and answer that one first. So our database for the market approach and the cost approach, we really recommend that you don't look at companies doing in excess of about $25 million a year in adjusted gross revenue. It's about where our confidence levels start to skew. So when you're working with companies above what we kind of typically call that medium size range, and you're going medium and above, that's when I would suggest that you start looking at public company data, SEC records, et cetera. Somebody already asked about ERI, and we'll get to that here in a couple of minutes. ERI uses a lot of that information. Sometimes you get into companies of that size range and up, those are other good sources. But for those 25 million and down closely held companies, RCReports should give you the numbers you're looking for. So where do we get our wage data? Well, when we developed the software, what we learned is without good base data, everything else falls apart. So we went out, we looked at all the different data sources that were available out there. There's a tremendous amount of privately collected data for different industries. The problem with it is that the scientific method of them being created, and I'll introduce you virtually anyway to our VP of our data sets and analytics named Bill Schneider. And what his conclusion was is the only data that's being collected out there, that's being collected in enough volume and with enough confidence and high levels of data, is public survey data. So that's what we use. We scrape all the public survey data that's being produced by the Bureau of Labor Statistics, State Departments of Labor, the Bureau of Labor Statistics. We take that data, we clean it, and then we complete it. And so just over half, I think it's somewhere between 55 and 60% of all of our data points are unique and specific to RCReports, but all based on the high level of collection that is performed by the different government agencies. If we find data sets that are collected at that high level, absolutely we would consider bringing them in, but we haven't yet. And we may get into some of those questions here in a little bit. Continuing along those same lines, we have a summary of the methodologies that are used in each of our reports. However, we have a very thorough, complete methodology report that we can provide to you upon request. Your BVR representatives all have a copy of this report that they can send out to you upon request as well. So I can tell you up to date in any litigation or IRS examination, almost all of our reports are accepted on their face with the summary information that's included in the reports. But we also recommend that you include the full-blown methodology report, at least in your working notes, in case you need to refer to them under examination, etc. So we're happy to provide that. Each annual data set that we produce, we also keep an internal report. Very, very detailed of everything that we came across, all the adjustments, all the completions, everything that we did. And all that's overseen by Bill Schneider. He's our VP of Data Sets and Analytics. Bill is an expert in predictive analytics. He has experience as an expert witness in that area. And he was also nominated to the Civilian Advisory Board for the BLS. We have offered Bill up as an expert witness when needed if one of our reports is being challenged as far as its credibility or admissibility. We haven't had to do that as of yet. Right now, in the early years, we had to offer that up quite a bit, but we've become pretty well known over the last few years, especially with the IRS. Courts are all over the country, so that's a little harder one to zero in on. But he is there. We're happy to offer him up. He'd be more than willing to come and back up our methodology. We talked a little bit earlier about professional judgment. So I'm not going to spend too much more time on this, but these are some of the common reasons you may want to make a adjustment from one of our reasonable compensation figures and use that advisor worksheet. Reconciliation, you could use it for that as well if you want to reconcile multiple reports together to support your conclusion. Speaking of supporting conclusions, litigation, and backing up your conclusions, when you start talking about being an expert witness, backing up your conclusions, etc., and you're headed into court, there tends to be two schools of thought when it comes to which approaches or methodologies to use in reasonable compensation. Multi-factor and investor's test. Well, overwhelmingly, multi-factor tends to be what we see in court the most. And when we talk about multi-factor, what we're saying is we're going to take into consideration all the things we should take into consideration for what that person is doing for their company, and use that, I like to call it kind of as a stress test against the reasonable compensation figure that is being either challenged or proposed. And the list of different factors are significant. There's quite a few of them out there. There's some as short as 6. There's some in 12, 13 range. A couple of the different court cases that you may want to be aware of if you're citing multi-factor cases are Brewer label graphics, and then the IRS fact sheet, which is a compliance document, also lists a number of different factors. So by far, that's going to be the one that you're going to probably encounter the most in court, and that would be the cost and market approach are going to be considered multi-factor solutions or figures. The other one is the independent investors test or the income approach. You don't tend to see that one very much. It's just more of a test, but you do tend to see it used in some courts. And even when it's used in some of those courts, they still tend to come back to comparability data to kind of come up with a figure, and this is more of a way of testing it. And here's some of the court cases for the independent investors test. Just briefly, I'm going to pull this up so I don't forget, and we can come back to it if we need to, and I'll spend some other time on some of these other tabs if you're interested. In our resource library here, we have most of those key court cases for you. So if you want to pull those court cases down or you need them for backup, etc., you can grab them in here. Heading off to court. You want to be able to pass a Dalbert challenge. To do that, you need to know what the sources of data are. Again, that's included in our methodology report. how these sources of data have done in court and with the IRS, and what are the methodologies that are used. So typically, when I've talked to evaluators and started to get to know your industry back in 2015, these are the three common data sets that I heard the most about. ERI by far was number one, RMA, and MGMA for the medical industry. Just know what their pros and cons are and what their track records are in going to court. If you want more on that, I'd suggest grabbing Michael Gregory's book. He also has a freebie book on his website just on reasonable compensation, and he'll talk more about what the pluses and minuses are specifically about ERI. In a nutshell, from the IRS's point of view, ERI is highly recommended, and you'll see that in the Job Aid as well, that they don't use it as a source or a resource to determine reasonable compensation, but more from benchmarking to see if a reasonable compensation figure, kind of like the independent investors test, is falling outside a certain range. So ERI has mixed results in court, depending on how it was used, the different data sets that were used. In my experience, and I haven't spent a great deal of time getting to know ERI, they tend to take public company data and boil it down for the small and medium-sized business, which dilutes its confidence level and its accuracy. And that tends to be, when I've seen it fail or not used, tends to be what the feedback is. I think for larger companies, I think it's a pretty good source. But we were built for the small to medium-sized company. So I think when you're looking at especially those micro companies up to that $25 million range we discussed, I think our data sets are much, much more accurate. A couple of pieces of advice here. There's a lot of subjectivity that goes into reasonable compensation, and one of my favorite court cases is a compliance case called McAlry. Determining an employee's reasonable compensation is dependent upon a number of factors and is far from an exact science. Absolutely. Having that roadmap showing how you reach that number is key. There's a small group of reasonable compensation experts in the country, and I've mentioned a couple of them already. One is Stephen Kirkland, who I mentioned a little earlier. I've gotten to know Stephen over the years. I can't consider him a friend. He was one of our early users. I think he's like account number 20 or something like that. A couple of great pieces of advice from Stephen. If he was here, he would likely mention these. First off, try to manage your client's ego. I mentioned that the woman who was paying herself $7 million. I have no doubt she believes she's worth every penny of that. However, from a reasonable comp standpoint, she may only be worth $500,000 or $750,000 or $1 million, and the rest should be dividends, since that was a C Corp issue. Also, when you're getting to know your clients and interviewing them, it's important to try and pull out your own personal judgments about that individual or that client. And it might help you make better judgment calls or subjective calls as you're looking for comparability data or running reasonable comp reports in some of the selections you'll make. And I suspect a lot of you also know Ron Sr., and he wrote a book with Kevin Yiannopoulos on reasonable compensation. This book came out prior to 2010, before we existed. And their second edition is due one of these days. Not quite sure when. It's been due for quite a while, but we're flattered that Ron is including us as an additional resource in his book. We are also incredibly humbled that Michael Gregory, Stephen Kirkland, and Ron Sr. all use us and endorse us. And we even more appreciate the fact of how much they contributed to helping us build a platform that met the needs and requirements of the valuation community. So I'm going to leave this slide up here for a couple of minutes and spend some time answering questions. I can also pull the software back up if we need to. And Andy, I don't know if you want to do any kind of a moderation, but I'm going to start looking at these questions and trying to kind of hit them as we go through kind of in the order that they were posted.
Do it as they come in, or however you want to do it.
Sure. Yeah, let me just kind of go through the questions. I can read them out. I'm not sure I understand that question. I might come back to it. Hold on a second. What if you are needing compensation for multiple C-suite positions, not just one overall executive? I'm not 100% sure what we're talking about there. Maybe we're talking about different executive level positions, such as chief financial officer, chief executive, etc. You still want to use that same category. Those different titles, when we do our collections, are lumped into the same bucket. So although it wouldn't, the report currently, and we'll expand this out, this is one of the feedback we've received, we'll expand those out to include CFO, but the data sets being used are going to be the same, because that the data at that C-suite is all collected the same, which has its plus and minuses. It gives us enough to be able to give you a good number, but it doesn't break out what a CFO makes versus a CEO. So that may be an adjustment that needs to be made manually. If I didn't answer your question, go ahead and clarify that, and I'll take another swing at it. When a company cannot afford the reasonable compensation salary that is determined, let me start. Let me take it. Let me back up and start from the beginning. When a company cannot afford the reasonable salary you come up with, do you accrue the cost on the adjusted financial statement used for the valuation? That's a great question. Unfortunately, that's outside my purview. I am not a CPA or evaluator. I'm an expert on compensation and how to determine it. So we may see if we can get some of the other folks that are with us who are much, much smarter to take a swing on that one, see if we can get that answered for you. How do you determine the value of a personal guarantee of debt? I knew that one was coming. I don't have any good information for you, but I can tell you in court cases, it's been allowed to increase compensation or give greater compensation to folks that have personally guaranteed debt. There is no good database or articles or anything else on what that amount should be. Now, I have seen more than any other number used, 10%. But there is nothing to back that up. Literally, I can't say use 10% because X, Y, Z. It's just a number that tends to pop up fairly regularly. Somebody asked if our database includes wages for lawyers. It does, and attorneys, but it's not going to break it out by levels of associate, et cetera, because the data just isn't collected in amounts that large. Some associations may collect it that way, and it might be helpful in helping you gauge what maybe proficiency levels or different areas you want to rate people in. But be careful using it in litigation, because if they didn't use a scientific method for determining it, which is what got MGMA data thrown out, that was a problem. And this isn't a knock against MGMA. Their data wasn't put together to withstand litigation or be used in with the IRS. It was collected as a benefit for the association, and when it was collected, it wasn't made clear, or either that or they didn't have a preference as to whether profits were included in those numbers. So the wage ranges that doctors were reporting were including profits. And so that was, and I wish I'd done a better job of remembering the court case that Kevin Yiannopoulos talked about, that MGMA data was not viewed as credible because of that. So really, it's about the foundational data and how it was collected. But let me go ahead and pull this up for you just briefly, because you did ask about the different wages. We have a tool in here where you can quickly look up wages on the fly without running a report. So if you were to, I'm just going to go back to Colorado. Well, let's go with California, since I clicked on it. Los Angeles. If we type in lawyer, do a keyword search, we can pull up lawyer and just quickly look at wages for the local, state, and national level in both an hourly and annual range. So those of you, so whoever asked that question, no, we're not going to break it down by associate, but you might want to have either a partner or a senior attorney up at the higher level of proficiency, and maybe somebody just getting through the bar down at the lower end. So I'm not sure if that helps or answers your question, but should give you some idea. And it looks like attorneys in LA do pretty good for themselves from a reasonable comp standpoint. Somebody asked if we had comp data for Puerto Rico. We don't. It is collected, but not in the volume that we would need to be able to produce a credible data set. So we'd like to add that along with the Virgin Islands, some of the other protectorates, but right now there's just not enough data. Somebody asked for an example, so I'll come back to that and I'll just kind of pull up and we'll just do a quick look at what compensation might be for, I think they were asking for a trade contractor. Just as you guys can see another example of how that might work. Somebody asked if there's a way to customize the wording in the reports. We do have quite a few people that customize that and they use a PDF editor. Become pretty standard. When you do make those edits, just remember that we are fully backing up any conclusions and any information in our reports. If you change any of that information, obviously, if there's an issue or a challenge to it, then we need to talk. Somebody asked, many service companies do not report gross profit. How do you deal with that? You might have to make a judgment call on what that number would be. We work with ranges, so you don't need to be spot on or specific. But you will need to choose from that drop down, otherwise we won't be able to produce a number for you. Somebody asked what the difference between basic and premium is. I would highly suggest that if you have a BVR rep, reach out to them. They have this software on their desktops. They can run you through specific examples for what might work for you and kind of go through the differences. The biggest difference are, in my opinion, from what our users have told us, is that reports are specifically white labeled with your information on them. Phone support, although the BVR reps are so well trained now that most folks call their BVR rep directly instead of us because they have so much more experience and information working with valuators, but you're always welcome to call us as well. But white labeling's a big one. Number of seats, that you get an extra seat with premium over basic. And if you're curious about that, simply just pop over to our homepage, click on Get Started, and you can run through the feature grid as well as frequently asked questions as to what's different in there. And of course, you're always welcome to call us. Our number's right up here on our website. The question I'm not going to be able to answer, not being an evaluator, about discount rate. So if anybody else on the back end, Andy or anybody back there wants to take a swing at that one, please do so.
Well, yeah, you could. I mean, some people view a personal guarantee not as, services rendered, but more as a risk issue. And so, yeah, you could. But I think, Paul, as you said, most people adjust to compensation, and I would guess you could just push somebody into a higher range if they are personally guaranteeing debt. Also, I think I understand you also should take into account the personal net worth of the individual. If they have a lot of wealth outside of the business itself, it may be less risky than if all of their wealth is tied up in the business, for instance. So that's another thing you look at. But there's no formula for this.
Gotcha. Yeah, and somebody asked about whether this was built for micro businesses versus kind of the medium-sized businesses. It's exactly what the cost approach reports were built for. We came up with fairly large compensation figures today for Johnston Signature Homes because it's a pretty good size concern with a number of employees, but somebody asked specifically about what reasonable comp might be for a plumber working on his own or maybe with one or two other folks. So let's reset this, and if you only selected a single compensation point in the cost approach, such as plumber in Denver, Colorado, actually we'll go with Boulder, Colorado, plumber, and he's working 40 hours a week. He may not be working 40 hours a week, but let's say he is. You're going to come up with a reasonable comp figure in Boulder of $80,000. And if he's doing other things for his business that don't pay as much, that number could reduce, and that's at the high range. At the lower range, 37,000. So does this work for micro businesses? Absolutely. Matter of fact, that was our main focus when we originally built it. The industry or the market approach data set came along for two reasons. One, we wanted to provide industry-specific data, but it also tends to fit for more larger size or what we call medium-sized businesses. So hopefully I answered that question for you, because I know I think that's what you're trying to get to. If not, please reach out to me. I'd be happy to talk with you more about your specific need, or grab your BVR rep and talk with them a little bit about it as well.